Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinar is for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. We'll drop the disclaimer from the stage and let's welcome Dimitri Pargamonic to come on and talk about setting up and analyzing double calendar spreads. Is that correct, D? That's what we're looking at today?
Yes. Good morning, Will. How are you?
All right.
Let me share my screen. And yeah, what we'll do is take a look at a double calendar spread. Set one up, involves 4 legs, and then analyze it from a perspective: when would somebody try to use a double calendar spread, based on a certain forward-looking outlook, the potential risks, rewards of a double calendar spread, and how do we change the parameters around to test out how that portfolio that we set up is, how sensitive it is to time decay, implied volatility changes, stock movements. So let's get into that. And I'm going to use SPY for our example. Let's type in SPY in the search box. It'll take us to the main page of that symbol that you type in. On the left-hand side, you have a menu. We're going to click on Options and Option Chain because we're going to set up the strategy directly from the option chain, and then we're going to run an analysis on that strategy to get further insights. Let's close this menu to expand our screen. Now we're on the SPY option chain, and here we see we have different expirations that are available for trading. These have listed options on them. If you click on that expiration, it will bring up the option chain for that expiration. So when we look at a double calendar spread, it's going to involves 4 legs, and instead of doing a calendar spread like a call calendar spread or a put calendar spread, we're going to do both at the same time. Okay, so let's do an example first of just a call calendar spread. Okay, so let's pick, we need 2 expirations. This involves 2 expirations on the same strike. So we'll pick the first expiration will come out here, and let's pick one that has some decent amount of volume. Here's one May 23rd. If we click on that, this has 5 trading days to go, 7 calendar days. And we'll start out with our first leg here. And we have to pick a side. You're either long or short a calendar spread. We're going to just go with analyzing a long calendar spread, which involves selling an option in the near-term expiration, and buying an option on the same strike in a further out expiration. And here we see the stock price is 594. And what we're going to do is set up a calendar call spread that has a little bit of a bullish bias. So when we talk about a calendar call spread, we have to pick a strike. Right? So you have 2 expirations, but you need to pick a strike. And the strike is based on your forward-looking outlook on this May 23rd expiration. Where do you think the stock will more likely float to? Okay, and that's the start of it. So let's pick a strike. Maybe that's let's say we believe that the stock SPY from now to May 23rd. Our analysis says that the 600 strike is our optimal strike where we think is going to float to. So the first thing we do is sell that 600 strike call. Now we're going to go out further in time, and we're going to pick an expiration, like in a calendar spread, where since you're buying a further out expiration, you're going to have a positive Vega position, meaning you want the implied volatility on the longer term option to increase. You own that option. So if you own that option, you want the implied volatility to increase. So the idea here is that from now to May 23rd, we think that the stock will float up to 600. We'll get the decay on this option, but the implied volatility on a further out option will increase on that 600 strike. So let's just, for our purposes, we'll go to, I don't know, let's pick something like June 20th. Okay. So I'm going to bring up the June 20th expiration. Now you could see this one expires in 23 days with 35 calendar days. And we're going to go ahead and buy this 600 strike. So you could see here, now I have a call calendar spread. Selling the May 23rd 600 call for $1.83. It's just those were the displayed prices, and buying the June 600 call for $8.30. So let's just run that analysis just to see what it looks like potentially at expiration before we do another calendar spread using puts on a different strike given these two same expirations. Okay, so let's do the run analysis. And we have a lot of statistics here, but I'm just going to go here just to show you what it kind of looks like potentially at expiration on May 23rd. So we're looking at May 23rd expiration because the first leg of this spread expires May 23rd. So after May 23rd, this is no longer a calendar spread because the option on May 23rd will either expire worthless, so then you just have a call, or it's in the money, which gets assigned to you, and that way, if you do nothing, you come in with a stock and a call, but it will no longer be a calendar spread. So we want to run an analysis based on where we think on May 23rd, when this spread no longer is a calendar spread. And we see here that if the implied volatility stays the same in this June 600 call, this is what the potential payout diagram looks like. And you could see here at the 600 line, right? That's where this stands to do the best, because if at expiration it's at 600, well, at that point, what happens is the call that you sold will expire worthless, right? If it's right at 600, so you get to keep that premium that you sold it for, and the call that the June 600 call, it's right at the money. So that's where the time premium is the highest, right? Where an option is right at the money. The other options either have intrinsic value or they're out of the money. So that's where the time premium is the highest. And let's assume now that our assumption is the following. We believe that the stock will either hit 600 or maybe on the downside 585, or actually, you know what, let's do this. 600 might be too close to the current app. Let's move these up to 610. Let me see if this has any premium. 610. Let's move these up to 610. It'll be a little bit easier to see on a graph. Let's move it up to 6. There's not enough premium here in the 610. Let me do the 605. See that? So you can see here in the 605, if the spot price is 594, here's your 605 to basically move up $10 from here. But let's say our outlook is that on the downside, we think that you're going to hit 605 or 585. And our outlook is still that we think between now and the first expiration, it'll float up to there, and the implied volatility in that June expiration will increase. That's what we want. We want to hold this position to May 23rd with the assumption that the implied volatility on those longer dated options, these June options, the implied volatility will increase. So now we need the next part of the double calendar spread, which are the puts. So we're going to go over here. And since we're on June 20th, let's first go to the 585 strike. Okay, we'll do the 585 strike. And we'll buy this put because this is the longer dated option. So you can see here, we're buying the calls and the puts on June 20th expiration. Okay, but we need to now go back to the May 23rd expiration to sell that 585 put. So we have all the legs to our double calendar spread. So I'm going to come back to this May 23rd expiration. Now we find the 585 put, and we're going to go ahead, click on this. So now we have all four legs. And you could see here, we do the May, June 605 call spread, and then we do the May, June 585 put spread. All right, 2 calendar spreads, 2 different strikes. Let's run that analysis and see what that potentially looks like at the May 23rd expiration. So run that analysis. And here you see now we have these 2 kind of sweet spots on either side. 585, the 605, and we have these potential loss here. And then if it escapes out of there, it's a bigger and bigger loss. It's a net debit of $11.06. Now that we have this set up, this is an initial potential pad diagram at expiration. Let's analyze this a little bit further and use a tool to see if we could change some of our parameters around and see what is the impact of time decay on this strategy. What is the impact of the implied volatility on this strategy? Let's start changing these parameters around so we know, the sensitivity of this strategy, of this portfolio to different risk factors. So we're going to go here to the summary and hit pricing and risk sensitivity. So here we go. We popped up with this new tool, and here we have the same 4 legs populated. You can see here the 2 options in May, selling the May 605 call, selling the May 585 put, and then buying the June 605 call, buying the June 585 put. These are the days to expiration, the current implied volatility of each one, the interest rate. Here's the initial strategy. So you can see it's $11.06 if we go ahead and execute the strategy on the displayed bids and offers. These are our sensitivities, delta, gamma, vega, theta. And on the bottom here, we have a little bit of a different chart here. And this shows us the initial potential gain and losses on the day if nothing else changes, if not, if implied volatilities don't change, the interest rates don't change, the time decay. What does this look like if the stock moves today? So you could see here, these are your potential risks and rewards. So it has a slight positive delta here. So on the upside, it stands to gain unless it goes up too much. And on the downside, it loses. And now, so this is on the day, right? This is if the stock moves right now. What if we want to see how does time decay impact this strategy? If time goes, from now to tomorrow, we have these days till expiration. So let's move that forward. And we see we have 7 days to May 23rd expiration. So let's see if we move it from 7 days to, let's say we move it to, and this is as of Friday's close, so we're not open yet. So there's a weekend right now. It's Monday, but let's move it to May 20th. Right. So let's see what would this look like on May 20th if the implied volatility stayed the same, interest rates stayed the same, and all we did was move it forward to compensate for time decay. So we're going to hit May 20th, and we could see here now we subtracted four days now to expiration. Okay. We're going to run this analysis, and now we get the new risk parameters here. So here you could see we started, the strategy was $11.06 debit. If everything is the same, stock price is the same, and implied volatility is the same, all we did was just move it forward to May 20th, then the decay is in our favor. This strategy will be worth $11.31 by our estimate versus $11.06. So obviously it's higher. So the time decay worked in our favor. And you can see here we have a positive theta, which all makes sense. Our Vega is high, so it increases. Our delta decreased a little bit. And here is a chart which shows the blue line is our new line based on the assumptions that we moved forward in time versus the yellow line, which would have been the line on the present day. And here we could see that as time goes on, the decay is in our favor. So as the stock goes up, you gain more, even up 1.5%, this still gains $23.88. But then eventually, if it goes up too high, you start losing. On the downside, it's still losses, but not as bad as on the day, because now we have more time decay. Okay. And let's see, what do we stand to make if our assumption is, because our assumption is that we think the implied volatility in those June options start to increase. So let's see our potential reward given our outlook or assumption for looking. So here I'm looking at June expiration, and this is currently the call is 13.6, has a 13.6 implied volatility, and the June 585 put has a 16. And these are the May 23rd. So for ourselves, let's assume that May 23rd for now stays the same. The May 23rd 605 call implied volatility will stay at 11. May 23rd 585 put implied volatility will stay 14.6. But we think that the June expiration, but in 4 days, will tick up by 1 volatility click on each option. So this will go from 13.6 to, let's say, 14.6. Right? So I just added one vol click. And let's say on June 585, put the same thing. It went from 16. We think it's going to go to 17. So you could see here, I added one vol click to each of these options, subtracted 4 days from all of these options. Let's run that analysis. So here we go. And now we see that from the current strategy of 1106, it'll go up to $12.63. So obviously that's good for us if it's worth more than what we paid for it. And over here, we see how this strategy will do along different strike prices, So as we go up, we could see that our potential profit increases. Okay, even up 1.5%, 2%, we're still in the profit. Even on the way down, remember we were losing, but now what we have is some time decay plus an implied volatility move in our favor that will offset it and gain and result in gains up here. So once it moves down 2%, we could see that then it starts in the losses here. And what we did here was set up a double calendar spread based on a certain outlook, right? That the stock will either hit this or this point by that first expiration, float to either a higher strike or a lower strike, and that the implied volatility on the longer term options that this strategy involves buying, implied volatility will go up. We set it up, that strategy, looking at the current market displayed prices, and we started to use a tool to change those parameters around so we could get a sense of what do we potentially stand to make or lose. On the other side, we could maybe go the other way and say, what if we decreased it by 1 block? Instead of 13.6, we went the other way. Decrease this by 1 vol click, and then we decrease this one by vol. So I'm going the other way now. Run that analysis. And here we see now it results in a loss. So we start out at 1106, and if time goes by 4 days and volatility decreases by 1 on the June, this goes from 1106 to 999. So obviously if you paid 1106 and it's worth less, it's a loss. And here are simulated losses along different strike prices. And this is one way to start looking at your strategies, seeing if it aligns with your unique outlook, and testing out the potential risks and rewards of that strategy to see if those make sense to you, right? The risk and reward that you're simulating potentially doesn't make sense, and how strongly you feel about that outlook. Well, I'm going to stop right there. I think that was an good overall review of that double calendar spread.
Yeah, that was great, D. I didn't want to interrupt you as you were presenting, but we did have a question from a new chameleon visiting for the first time, Demange, and he asks, and I'm not exactly sure, so I'm going to ask you the question to see if it makes sense to you. I wasn't exactly sure what he was asking. He asked, why does the put calendar sit lower, shorter than the call calendar, taller? Is this always the case, or just in this description?
So just in this description, we had to select, when you're doing a double calendar spread, you have to pick strikes, and those strikes are based on your outlook of where you think the stock potentially can go from now to that first expiration. So for our illustration purposes, I had to pick two different strikes. What I did was pick a strike in the call spread that were higher, based on based on a theoretical assumption, because I needed to do a demonstration. So based on a theoretical assumption that our analysis says it'll float to 605. Then at the same time, well, if I'm doing a put calendar spread of different strikes, I have to pick a strike. Again, it's going to be based on your unique outlook, not something I say, but for our illustration, we needed to pick a strike. So I made up a strike of 585 as a way to say, well, maybe it'll go up from here, or maybe it'll go down from here $10. That's my assumption. Okay. From now to May 23rd, either go up $10 or down $10. That's my ideal points. So I set that up so we could run an analysis on these and show you how you could run that payout diagram and sensitivities. You could pick strikes, different strikes, and then run them to see if that makes sense to where you protect. You could take strikes closer, further apart, whatever you want, based on your outlook. So there, if you're saying why did I pick 605 and 585, there's no particular reason other than we needed to set up a calendar spread and we needed to select the strikes for our illustration.
All right, he came back and he said, call calendar max profit is higher than put calendar max profit. This is what I meant by taller and shorter.
So kind of like over here. I'm assuming. Yeah, so that itself is possible because remember the prices, the market prices are different, right? So market prices of call spread and put spread are different. Plus, this has a little bit of a delta skew. So it's very possible that because of the market prices and skew, right, that one side, even if it was equal distance, may actually be, the max profit could be higher than max profit on the put spread, because you're not paying exactly, you're looking at different, market prices here, right? And that's what it's analyzing here. It's analyzing different market prices, and you're starting at 594.16. It's not exactly 595. So you have to take that into consideration as well, where if you look at if you simulate, let's say you simulate a double calendar spread where you're not using market prices, you're just making up prices, which are like equal, $2 for this spread, $2 for that spread, you're right in the middle of it, then it'll look different. But here we're using market prices, and the stock price is not, exactly in between the 585, 605. It's not the strikes, the stock is 594.16. So that's why you're seeing a little bit of a skew.
That was perfect, D. Thanks so much. We're right up against the start of the opening bell, 9:30. Just so everyone knows, tomorrow we won't be having a show. I have a family event I'll have to attend. So our next show will be Wednesday. Great job as always, D. Thanks so much for this. Thanks everyone for joining. Remember to follow us, thumbs up, and a big thanks to everyone for joining today. Great job, D.
Thanks everyone. Stay safe out there and have a great trading day.
We'll see you on Wednesday, everyone. Have a great trading day. Thanks, D. Bye.